guys, welcome back to today's class, and today we are going to see another concept called bonus and rights issue. All right, let me connect now, just a minute. And before moving on to the session, see in the description box we have added one Telegram channel link. Okay, so this is regarding the regulatory exams. Okay, so there in that link you can find the study material, mind maps, questions, and top 10 MCQs, so many things which will help you, and it is absolutely free of cost. So you can join in that. You can join through that link. It is there in the description box. All right. So all your regulatory exams, not only SEBI, all your regarding your regulatory exams, you can get the free study material, mind maps, and so on. All right, to help you out. Right. So now we move on to the class. All right. So in the last session, we have seen, buyback of shares, right? So in your syllabus, if you see, there are few things like, issue of shares, bonus issue, rights issue, and then you have ESOPs, and then buyback of shares. So these are all related to shares. Okay. So last class we have seen buyback. So this class we'll be seeing bonus and rights. I'm trying to cover these both in today's session. If not, it may it may be covered. If I couldn't complete, then it may be take covered in the next class also. All right. So please understand these basically these issues, issue of shares, or issue of rights or ESOPs, all these things, all these chapters, there may be two kinds of questions that might come. Two types. One would be journal based question, and the second would be based on certain formulas, or because even here the Companies Act will come into picture. Okay. So here even you have to study both, because the compliance part, and for what you can use, how much you can use, and which reserve you have to use, all those things are told by the Companies Act. So theoretical questions may also come, or journal based question also might come. Okay, only these two kinds you may find in these type of chapters when you talk about bonus, rights, and buyback. Buyback, at least you have few concepts like resource, I mean, like how much you can buy back, the maximum limit, minimum time gap, so many things are there. But when we talk about bonus, it is very simple chapter. It is very simple. It's only talk about the compliance, like how much, not how much, from where you can finance the bonus. All right. And when we talk about rights, there are two types that you may come across there. One would be journal oriented questions, and second would be finding the value of the right. That I'll explain what is it when I go to the topic. So before moving on to that, now you might know what is meant by face value, what is meant by premium, what is meant by discount. I just given here basics. All right, so face value is the one which is printed, nominal value or face value on your certificate, and if it is issued at a premium, though the issue price, whatever it is, guys, it is not only for issue, any price, even if you are buying back, all right, or if you are issuing at a price more than your price printed on the share certificate, that is your nominal value, then that is called premium. Okay. When you receive funds, it is a capital receipt. Understand that. When you matlab, you here means, you means company here. Okay. When a company raises funds, when a company issues shares at a price more than the face value, then they are receiving money. So it is a capital receipt. The premium, it is called securities premium, and it will be kept under a separate reserve. Reserve means it's nothing, but I told you already, it is like an account. That's it. Okay, so it is a separate account called securities premium account. It is a capital receipt, so it will be shown as a under, and it is, and this is owned, and this is towards the shareholders funds. You are getting it? This is towards the shareholders funds, so it will be shown under the shareholders funds under the equity heading. Okay, so when you are issuing at, or by issuing at a price less than the face value, then that is called issuing at a discount. But 2013 prohibits any shares issuing at a discount. So it is, now you don't see this kind of scenarios except in case of ESOP. Because there are certain cases where you can issue at a discount. Law Companies Act has permitted it. In one of, in that one of the scenario is ESOP. ESOP means employee stock option. There you can issue at a discount, or even you can issue at a free of cost. Usually you are getting it. So now if you go by provision, now as per Companies Act 2013, you cannot issue, a company cannot issue a shares at a discount other than ESOP. That is a rule. You're getting it? Now, coming back to bonus, first of all, understand what is meant by bonus issue. Bonus means what? It is something called extra. Correct. It is something called, free of cost, right? When you buy something, if you're getting something additional, that is called bonus, right? So the same way goes here. The company, the corporates, they will issue the shares to their existing shareholders. Remember that this bonus will not be given to every, it is not like a public issue. Guys, whenever the company is issuing shares, they will issue shares for paisa. First thing, what is the main intention of going public issue? They wanted money. Now, correct. Now you guys would have followed so many IPOs now, right? So why they are going? They will issue shares. They will collect money from the people. So that is called public issue. It could be IPO or it could be FPO, right? So now what is meant by bonus issue? Why the companies will issue this? Guys, why the company will issue is, that question is, it's not relevant for your accounting or for your Companies Act card thing, all right? But when they will issue, how they will issue, that is the question here. Basically, that's the thing you should, you should understand in Accountancy and Companies Act. Why they will go, that is your, financial management and, business management, you can study there. They will tell you why they will go for bonus issue. Capitalization of profits, they will say, and they don't want to go for dividends, and they don't just wanted to, give benefit to the shareholders. Correct. There are so many things there out there, right? So now coming to bonus issue, the corporates, what they will do, they will issue shares free of cost, additional shares. Say for example, I am having say 100 shares with me of Infosys. Now Infosys is coming and saying, whoever is my shareholder, please come. I'm going to issue, say 1:10 ratio. I'm going to issue additional shares. It is free of cost. So as a shareholder, I will be getting, for every 10 shares, I will be getting 1 share extra from them. So basically, here the company will not receive any money from the people, from the existing shareholder. It is completely free of cost. Now, how they will issue, ma'am? Accountancy is all about dual accounting. No. So one side they are issuing share capital, means a shares means a share capital will increase. Obviously, number of shares will increase. So obviously, share capital will increase. But money is not coming in, no ma'am, because we are not collecting any paisa from the shareholders. So what will happen to the debit side? What will happen to the dual impact? How it will be done? So there comes the question, how they are going to, afford it. This, I'm using the word afford. Why? Because to understand. Because I am not going to get money out of the people. I'm not going to get money out of my shareholders. But anyway, I'm issuing shares. So how do I nullify this debit effect? How will I get that double entry? Now, here I will use the word called capitalization of profit. Capitalization of profit. What does it mean? I have accumulated profits of so much. During these many years, I have reserves. I have reserves with me, I have profits, accumulated profits with me. From there, I will issue. Ma'am, it is similar to an issue of dividend. The answer, I won't say yes, but instead of giving money to the shareholders, I'm giving shares. That's it. So from the reserve, I am taking that money, not exactly not money. I'm taking that much equivalent amount from my reserve and parking it to my share capital. So this is called capitalization of profit. Here, bank account will not be impacted. Your cash flow will not be impacted. Remember, whenever they are talking about bonus issue, there is no cash impact. Why? Because it is mere capitalization of profit and nothing else. I am just using my accumulated reserves and I am just giving free shares to my shareholders, taking money or taking, impacting my accumulated profit. From there, I'm just moving the shares, moving it to the share capital. That's it. You're getting it. So this is how bonus issue will happen. Now I just extracted. You can study this in your study material. I've given the entire scenario, but here in this class I'm just explaining the few important regulations what SEBI has given. All right. Apart from Companies Act 2013, SEBI also has given certain regulations for bonus issue. Please understand, Companies Act has also issued certain conditions. All right. Apart from that, SEBI has issued. All right. So if you see, there are 3 or 4 regulations I've mentioned here. So first regulation is regulation 92. So what they are saying, who can issue bonus shares? You're getting it? Who can issue bonus shares? See, a listed company, any listed company can issue bonus shares to their members, provided first thing, it should be authorized by their AOA. That is nothing but articles of association. All right. Second thing, what they are saying, there should not be any default in their payment of interest or loans. Guys, understand. See, you yourself think. Uh, Suppose you have given money to your friend. Okay, you have given, or you borrowed money from your friend, and you agreed that you will be paying every month, say 1,000 rupees or 10,000 rupees, whatever it is. And one month you just purchased one iPhone, or you gifted somebody, something, you gifted another friend, and you told this friend saying that I'm not able to pay interest to you now this month, please wait. What that friend will say? He'll say, why you gifted him? With that money, you would have paid my interest, no? You would have paid my loan, no? Is it necessary now? They will ask, no, obviously. Correct, no? That's what even SEBI is saying. See, we are not prohibiting from you to issue bonuses. No, you can. But make sure you don't have any defaults in paying your interest or principal of your FDs or debt securities raised by you. Please make sure you have paid all those things. And even you should not have any defaults in your employee payments, statutory dues, your employee PF, employee gratuity. You're getting it, all right? And the third thing, what they are saying, this is important. Bonus shares can be issued only to fully paid up shares. If the shares are partly paid up, then you cannot do it. You're getting it? So make sure while you're issuing bonus shares, that bonus shares can be issued only to fully paid up shares. So if there is any partly paid up shares, make sure that it is fully paid up and then you go ahead for bonus. You can issue bonus to such shares. You're getting it? So this is regulation 92. Next one, regulation 93. What they are saying, suppose at the time of, when you decided to go for bonus issue, all right, 1 minute, guys. Yeah, it is on live only. Yeah, it is on live. All right. Because I didn't get the signal here, so that's why. All right, it is on live. All right. So please, what they are saying here, on the time of issue, suppose if you have any compulsory convertible debt instrument, CCDs we call that. What does it mean? Guys understand, suppose what happened, few companies will borrow funds, will borrow, they don't raise funds, they'll borrow, I mean they don't go for issue of shares. What they'll say, I will borrow from you now, maybe after a certain period of time, this instrument, say for this debenture or this instrument, can be converted into shares, can be converted into equity, can be converted into shares. You have preference shares also, convertible preference shares, convertible debentures. So when you have such kind of, at the time of issue of bonus, if you have any CCDs, compulsory convertible debt instruments, make sure that you are having a reservation of those things also. You are getting it? So you have to make a portion of your bonus for those things also. Then you make a bonus issue. That is a second regulation. Third one, what they are saying, regulation 94. This I said, no, capitalization of profits. See guys, when I talk about accumulated profits, it should be a genuine profits. That's what even yesterday, I mean day before yesterday's class also we saw. See, whenever I am going for buyback or whenever I am capitalizing profit, you should not use your notional gains. Okay, simply notional gains, that is not realistic. Correct. Simply revaluation reserve. Ma'am, why always you are talking about, because this is very common thing, guys, because revaluation will happen. Why? Because most of the companies, I mean, in India, we follow historical method of recording transactions for our, PPEs, that is fixed assets. Okay, PPE means plant, property and equipment. In local language, I can say fixed assets. Land, say for example, I would have purchased it 20 years before for say 50 lakh rupees. Now that land ka value might be around say 40 crores or 50 crores, but still I would be showing it at what, 50 lakhs. So now at some point I will think that I have to revalue. So I will revalue, I will write. But it doesn't mean that 50 crores, that surplus, whatever the appreciation, have I realized it? No, I didn't. Unless until I sell the land, I realize the money, there is no gain. It is just a notional. I myself is saying, okay, fine. Earlier it was 50, now it was 5 crores or 10 crores. So there is some appreciation. So to record to a current date, I'm just passing one entry in my books. That's it. It is not a genuine profit which I earned. It is not an actual profit which I earned. So that's the reason everywhere, if you see, even when you talk about buyback, when you talk about bonus, when you talk about other stuffs also, they will say you cannot use revaluation reserve. Why? Because it is very just a notional thing. So which reserve, ma'am? Because why they are talking about reserve is, if you go and see any balance sheet, you can Google and you can download a balance sheet of any listed company, you will see a heading called reserves and surplus. Under that heading, you all reserves will be coming up. Security premium reserve, general reserve, that is free reserves, and then profit and accumulated profits and loss, and then debenture redemption reserve, capital redemption reserve, capital reserve, and then sinking fund reserve, this one revaluation reserve. So everything will be coming up there. You're getting it? So the act is very much specific. What they are saying, Baba, you can capitalize your profit for issuing bonus. I don't have any problem. But please make sure that that profits or that reserves are genuine or genuine. Don't use revaluation. Not only that, even securities premium also, what they are saying, this is under SEBI, guys, remember. So this provision is only for listed companies. You are getting it? SEBI is saying only that too, that is only for securities premium I'm talking about. Rest is same for even other companies. That is, you cannot use revaluation reserve for issuing bonus. That is common in even 2013 Companies Act 2013 also, even SEBI also. But if you see securities premium, 2013 says that you can use securities premium. Companies Act 2013 said that you can use securities premium. They are not very much particular that whether the securities premium is collected in cash or not, whether it is realized in cash or not. They are not much particular about it. But they said that you can use securities premium. But SEBI has made it clear. What SEBI told is, securities premium you can use for issue of bonus only when it is realized in cash. cash in the sense you have received that money literally. There is no unpaid kind of stuffs. You're getting it. So you have collected that money and it is kept in a reserve. Only that securities premium you can use. You're getting it. So there is one catch point here. Remember, SEBI is very much particular, saying that securities you can use genuine reserve, you can use free reserve, you can use general reserve, you can use P&L. No, notional gains, so no revaluation reserve, nothing. But understand, when even securities premium you can use, but SEBI says securities premium should be collected in cash. Only that part of securities premium you can use for capitalizing your profits for your bonus share. You're getting it, all right? So this is regulation number 94, right? Next one, regulation 95. This talks about the timelines for the entire stuff. All right, when you start, when you started off this with bonus issue, and when you get your approval where you don't need shareholders approval, ma'am, when you these things you will cover in your Companies Act. Why? Because if within certain percentage of bonus issue, no need for shareholders approval, board's approval is enough, and then with that you can go ahead for bonus issue. But if you are going to issue more than that certain limit, then you have to go and ask your shareholders, you have to pass a resolution, then you can come up with the bonus issue. So there, these things you will study in your Companies Act. I've given all the notes regarding the same. So here what SEBI says, suppose where there is no need for shareholders ka approval, then once you announced that, please implement that bonus issue with board resolution. If you are going, please implement it within 15 days from the approval of the board. You have, because you are not going for shareholders approval, because you can go where you have the right to go with the board's approval. So once you got the board's approval, finish everything within 15 days. That's what they are saying. Implement the bonus issue within 15 days. All right. Suppose if you want to go for shareholders approval, you are getting it, for this capitalization and everything. So what they are saying, fine. So take 2 months time. Take 2 months time from when you decided. All right, when you decided, please read the line carefully, within 2 months from the date of meeting of its board, all right, wherein the decision to announce the bonus issue was taken subject to the shareholders approval. So the timeline is 2 months. So once the decision was made in the board's meeting, that is in the board meeting, and subject to the approval, shareholders approval, you have 2 months time in your hand. Within that you should finish. Remember, once you announced bonus issue, you cannot withdraw the same. You cannot revocate. This is similar to your dividend declaration. If you would have studied Companies Act, there is a chapter, dividend chapter, chapter 8, I guess, I believe. In that, section 124, all right, issue of dividend. There you will study one point. Once dividend declared, it cannot be revoked. It cannot be revoked. The same thing applies here. Once bonus issued, once bonus declared, that is announced, that cannot be withdrawn. It cannot be withdrawn. Remember that. All right. This is SEBI ka regulation. Now this is Companies Act ka things. What they are saying, same thing. You can, you can pay out of reserves, free reserves, securities premium account. Here they are not worried about whether it is realized or not, but as per SEBI's guideline, for listed companies, make sure securities premium is realized in cash, only that you are using it. Unlisted companies, you can use the entire securities premium, no problem. And third one, what they are saying, from CRR, you can, go for bonus issue. So you can issue bonus out of these three things: free reserves, securities premium, and CRR, capital redemption reserve. So this one, capital redemption reserve, we have studied in the last class, you remember. So this is as per, so ma'am, you said that one, no, that is as per SEBI, and this is as per Companies Act. Then when SEBI will come into picture, when you are talking about listed company, you have to combine both. Companies Act and SEBI guidelines, and you have to follow the rules. If it is not a listed company, then only Companies Act will be applicable. So again, both the things are same. Everything is same here and there. Only thing is securities premium part is little you have to be careful when it comes to listed company. You're getting it? All right. Now, this is theoretical question, guys. So far you have studied only theoretical, and accounting treatment, if you see, it is very simple. Just one entry. I have given two entries because to have a control, but if you can complete this in one entry also. All right. So first thing, once I announced the bonus that I will be going for bonus issue, I'll be issuing bonus shares. At that time, you have to pass one entry. And once you issued literally, at that time, I will be passing one more entry. That's it. This is the accounting treatment. That's it. All right. Now we'll see the entry. First, when I declared that I'll be issuing bonus, at that time, I'll be passing one entry. What entry, guys? See, what are you going to do? You are going to issue shares to whom? Shareholders, correct? So you have to give it to them, right? So now you have declared, right? You have declared, correct? So now what will happen? They are going to receive it. Now it's your liability. I won't say use the word liability, but you are obliged to issue, right? So now what will happen? I'll be crediting that bonus to shareholders account. So this is the account ledger name. So what I will do, I will be giving that much amount bonus to shareholders account. I'll be doing it. Ma'am, then where will you debit, ma'am? What I said, capitalization of profits. So I'll be moving it from my reserves. I'll be funding my bonus issue from my I won't say funding, but I can issue out of that debit I have to give. No, because I will not get money from the bank. I will not get money from the people. So my bank will not be impacted. My cash will not be impacted. But I need that where I will put that dual double entry things. From where I'm going to get that, paisa, or from where I'm going to get that reserve, or where I'm going to get that, fund. I'll be getting it from my own reserves. So what you have to do, you have to debit your reserves. So what are all the reserves you have? Which one you are using, you can debit that reserve. I have written all the reserves here, whichever you have. If you have CRR, you can debit CRR. You have securities premium, you can debit securities premium. If you have general reserve, you use general reserve. If you have P&L, you use P&L. Accumulated profits, if you have, you use accumulated. Ma'am, is there any order? If you ask, always you use first, you deplete first CRR and securities premium account. Why? Because these two accounts have specific purposes. Okay, securities premium can be used only for 6 purposes. Out of that out of the 6, one of the purposes is bonus issue. You're getting it? Why? Because general reserve and accumulated profits you can use for any purposes. You can use for any purposes. So you keep it aside that. Because when you have certain restrictions, first you have to deplete that. Correct? No, because securities premium can be used only for 6 purposes. Out of that, bonus is first one though. Then use the securities premium first, no? You're getting it? Because if I didn't use it now, then I cannot use securities premium at any point of time for any other purposes. You're getting it? So first choice, you will be using securities premium, second CRR, then third general reserve, fourth P&L account. You're getting it? So this should be ideal. If you do that, it is, it is ideal. You're getting it? Then once you issued shares, literally shares to your shareholders, now obviously you'll be crediting which one? Share capital has to increase, no? So obviously you'll be crediting your share capital account. Credit to share capital. From where? From here, bonus to share. So this account will get debited. So this and this will get knocked off. This debit and credit will get knocked off. At last, the final impact would be your reserves account debit to share capital account. That's it. This is the entry. This is the impact. This is the impact. In between, I'm just parking one intermediary account called bonus to shareholders account. So instead of parking straight, I'm just parking it to this, and then I'm moving it from this account to finally to my share capital account. That's it. So you remember these two journal entries, please. So you will be debiting the reserves, all right, and crediting the share capital account ultimately. So in between, you will be having one intermediary account called bonus to shareholders account. So that you at that point of sanction, you will be crediting that account. At the time of issue, you will be debiting that account. So that account will get nullified. You are getting it? So final impact would be this. So that's it. This is the bonus issue. This is all about your bonus issue. Nothing much on this. That's it. All right. Now I'm going ahead with rights issue. 1 minute. Let me have water, please. All right. Next one is rights issue. Now, so far you understood bonus. Now I'm going ahead with rights. Now remember, right is again bonus and right. Both the things are issued to existing shareholder. Just a minute. Am I live? I think I am live. Why it is not happening? Okay. I hope I'm live. All right. Now, so both rights and bonus both are issued to the existing shareholders. All right, bonus and rights. Now, what is meant by rights issue? You guys understand? As a company, I wanted to raise funds. I wanted to raise additional funds. Now, what I thought, okay, let me go and ask the people. All right. So, as if I'm going for FPO, further public offer, it is not that easy. It's very cumbersome, and it is very costly affair also, because I have to prepare entire prospectus and everything. I have to get approval from vetted by SEBI. So many things. I have to get so many certifications, so many things I have to do. All right. And I have to comply. I have to wait for the minimum subscription. I have to get it. I have to underwrite, brokerage, everything will be there. So what company will do is, instead of going and asking the public, why can't I go and ask my existing shareholders if they are happy and they can buy my shares? All right. So what I'll do, I'll go to my existing shareholders. I will say, Baba, see here, I need money. I'm going for a public issue. And before going for public, I'm just asking you guys, if you guys wanted to invest more in my company, I'm giving you a right. I'm giving you a right. Right means what? It is a privilege to the existing shareholders that the company is offering them, certain in certain ratios. They will say, you can buy my shares. Excuse me, guys. 1 minute. Excuse me. I'm sorry. Just a minute, guys. I'm sorry. I'm sorry. All right. So now what they will say, they will give a privilege, or they'll give a right to their shareholders, saying that, Baba, this is they'll give an application for you basically. If you are willing to invest further in my company, I'm going anyway because I'm going to raise funds. If you want, you can purchase at this price. Basically, the price will be little lesser than the market price. That right price what they are giving to me, that will be little lesser compared to what they are going for the issue. All right. So they'll say, I am giving you this benefit. Say for example, if now their public issue they are going for 10 rupees, so they will give me at 9 rupees 50 paise, or 9 rupees, or 8 rupees, like that. All right. They'll say, if you guys wanted, you can invest at this price. I'm going to allot you these many shares. They'll give you ratio. Say for example, for 3 is to 2. For every 2 shares, I'm going to give you 3 rights. If you want, you can buy. Or 1 is to 10, or 2 is to 5, like that they will say. So rights issue is nothing but, it is a right given, it is a privilege given to the existing shareholders, that they can buy the shares of the company. All right, they can buy the shares of the company before before it opens to the public. All right, and at a price lesser than the market price, I can say. This is called rights issue basically. All right. Now, ma'am, is it mandatory for the shareholders to buy? No, the answer is no. They will send a letter first of all. We are planning to go for this one, and we are planning to give you rights issue. If you are willing to exercise this right, please let us know. And please, this much is the amount you have to pay within so and so date. You have to send the check to us so and so. We will be allotting. So it will be like that. And if you are not, I will receive that letter from the company. If I feel like I want to invest further, I will say, yes, I am exercising the right, and here is the check. Please take it and give me the thing. Give me the shares. Now I feel like I don't have money now, I don't want to. I will say, no, I am renouncing my right. I am renouncing my right. I don't want. I'm just declaring or declining your offer. So I no need to buy. That's it. Third thing I have, what I can do is I can renounce in favor of somebody. What does it mean? My friend is so much interested in this company. Now I will ask my friend, Baba, I have this right offer. If you want, you can take this letter, offer letter, you can apply to the company. I can do that. So that is called renouncing in favor of somebody. That also the shareholder can do. And that fellow, that my friend can apply to the company and he can get the shares are getting allotted. You're getting it? So this is how it works. So before moving on to the exact journal entries and everything, because there are certain things you must know. Book value, we'll use the word called book value of shares. All right, what is meant by book value? So net worth divided by number of shares. All right, net worth divided by number of shares. That is called book value. You're getting it? Remember. All right, remember. Market price means what? Market price. All right. Now, market price, there are two things we can say. All right. One is come right and next is X right. What is meant by come right and what is meant by X right? The market price or the value of the share before this right is coming, no, before the issue of the right, whatever is prevailing, that is called come right price. Come right price before the issue of rights. All right. After the issue of right, whatever the market price that is prevailing in the market or the value of the share in the market, that is called X right price. Why I am explaining this is you have a concept of finding the value of right. So at that time you will come across a formula called come right minus X right. So ma'am, what is meant by come right, ma'am? What is meant by X right, ma'am? Come right means the market value or the price of the share before the issue of rights, that is called come right price. After the issue of right, it is called X right. Usually come right will be greater than X right. Usually. Why? You can Google it out. You have so many analysis, and I have explained this in my previous videos also, and even in my notes also. All right, you can check it out there. Right. Now, this is what I said, rights of renunciation. This I have explained you. So, renunciation, I have two things. Either I can decline, that is called renunciation, or I can renounce it in the favor of somebody. So, two things I have. As a shareholder, I have these two rights. All right. So, now, value of right. This is the one I was talking about. Value of right is nothing but come right price minus X right price. Ma'am, why are you, what is meant by value? This is a question, guys. They will ask you, find out the value of the right. All right, whatever that right ka, ma'am, why it is required, ma'am, guys? In your financial management, actually, this topic is from financial management, but I have included this because in accountancy, you don't see this. Okay, accountancy is purely, accounting treatment is purely journal entries. Okay, accounting treatment is purely what? Journal entries. But there you don't see any come right, X right, value of right, nothing of that sort. Accounting wise, you don't see anything. In your books, if I go for issue of right shares, how much, what is the right share, what is the right price, whatever the price, That one, how much I got from the shareholders, how much I issued the share capital, that's it. Only journal entry will come into picture. Okay. This one I have included from your financial management. Why? Because since it is related to rights, suppose if the questions are coming out of this, you might be knowing it. So that's the reason I have included this portion. So there is something called value of right. Value of right. So I mean, because they are giving no a 1:2 ratio, 3:4 ratio. So here what we are trying to find out is that how much I am giving that, how much value I'm giving to that shareholder. So that's called the value of right. You're getting it? That is a value of right. All right. So for that, to find out that, you have a formula called come right minus x right. Come right value minus x right. Come right means it's nothing but whatever your market price before the rights issue, that is called come right. That is called come right. I repeat, whatever your market price before your rights issue, that is called come right price. What is meant by x right? You have a formula for that. All right. Remember, I have given you just like a formula. I'm not, fully going into how this will be arrived, how that will be, why it is like that. This, why you will be studying in FM, financial management, strategic financial management. All right. Not in accountancy. Remember. All right. Now, how to find out X right value? Come right value of existing shares. All right. Come right value of existing shares. Come right means what? Market price before rights issue. So of existing shares, which means multiplied by number of existing, whatever the shares right now you have, that one. All right. Plus right shares multiplied by rights issue price. So how many shares you are going to issue as a right shares, that many number of shares multiplied by that issue price. So add these two divided by total number of shares. That is, total number means whatever the old shares and whatever the new right shares. Add these two things, that will give you total number of shares. So what is the formula now? I repeat, come right price multiplied by old shares, multiplied by old number of shares. I'm just writing in very colloquial language. Plus right number of right shares multiplied by right price. Okay, the whole divided by total number of shares. What is the total? This old, this right. If I add these two, that is total number of shares. This will give me X right value. So now the difference between come right and X right would give me value of a single right share. You are getting it? So remember this formula. Remember this formula. Here I have given a numerical example so that you can understand. A company offers new share of rupees 100 each at 25% premium to the existing shareholder on 1-for-4 basis. That is 1:4. Guys, understand, I'm just going to talk about only this one. Okay, so I'm not telling you how many shares are existing. Remember, now it is only, 1-for-4 means, which means 4 is the existing share. Correct? No. For every 4 shares, I'm gonna issue how many shares? 1 share, na? Correct? No. Because 1:4 means the ratio 1:4 means what? For every 4 shares, I'm gonna issue 1 share. So which means existing share is how much? 4. So right share is how much? 1. You are getting the point? For every 4 share, I'm gonna issue 1 share. Suppose if I have given the total number of shares, so then I can find out, say for example, 10,000 shares or 40,000 shares I'm having. Okay, now how much it will come? So existing shares is 40,000. Now how much right shares will be? For every 4 share, 1 share means now 40,000, so it would be 10,000. Correct? So 10,000 right shares I'm gonna issue, and already existing is total 40. So total it would be 50,000 shares. You are getting my point. All right. So here I didn't give you any consolidation. So I'm just going with the single strand. So for every 4 share, 1 share they are going to give as a right. Alright. So which means existing number of shares are 4. Right share is 1. So total number of share is 5. Remember that? Understood that? Next, coming to your issue price. Company offers new share of rupees 100 each at 25% premium. So which means your issue price is 125. Your issue price is 125 because 100 plus 25 rupees premium. So 125. Alright, this is issue price. Next, come right market price of a share is 150. So come right they have already given 150. Now value of right. Value of right is nothing but come minus x. Come I know 150. Correct? So I need to find out x right. How do you find out? X right. There is a formula. What is that formula? Existing. What is that? Come right value of existing shares plus right shares. Correct? So now I have to find out existing is 4 multiplied by 150 plus right share is 125 rupees into 1 share, the whole divided by total number of share is 5. Correct? If I do that, I will get 145 rupees per share. So now X right is 145. Now value of right is 5 rupees per share. Now getting it? So value of right is how much? 5 rupees per share. You are understanding it? I hope you are understanding. Alright. Remember the formula. Right? Now the accounting is very similar to your normal issue of shares. It's nothing but bank account debit to equity share capital account. If it is issued at a premium, then bank account debit to equity share capital account to securities premium account. It is as usual. I'm not going to explain this because it's a very common basic entry, because bank account will be debited by how much ever you are gonna receive from your shareholders. Equity share capital will always hit with your face value. If there is securities premium, then whatever the excess money that will be credited to the securities premium account. That's it. So this is the journal entry for your, this is the accounting treatment for your right shares. Here I have given of example. Company having 1 lakh shares of 10 each has it is issued share capital having a market value of rupees 46. Issue right shares in the ratio 1:2 at an issue price of 31. Remember, premium will be calculated from your issue price and the face value. No need to talk about your market value. This is just the summa they have given to confuse you. Alright. Now I'm going to pass the entry. Before that, I need to find out how much is the right shares they are going to issue. How many shares? Alright. Now 1:10. So for every 10 shares, they are going to issue 1 share, means 1 lakh shares I am having. So now how many shares they are going to issue now? 10,000 shares they are going to issue, right? So this is the number of shares. All right. Now, what is the issue price now? 31 rupees. So face value is 10. Then premium is how much? 31 minus 10, 21 rupees is the premium. So bank account, how much I'm gonna issue price only? How much I'm gonna receive from the shareholders? 31 rupees. So 31 into 10,000 shares, right? So 10,000 shares, if I put, bank will be receiving 3,10,000 from my shareholders. So bank account debit 3,10,000. 2. Equity share capital account. Always I will credit equity share capital with my face value. So 10,000 into 10, 1 lakh. To securities premium account, what is the premium amount? 21. How I got? 31 is the issue price minus face value. 31 minus 10, 21. 21 into number of shares, how much? 10,000 shares. So 2,10,000. This is accounting treatment. That's it. I hope you got all these things, correctly. All right. So go through once, read the notes so that you can understand completely. All right. So with this, I wind up today's class. Have a great day tomorrow and have a great night's sleep today. Good night, guys. And once again, I'm just reminding you, in the in the description box you have a Telegram channel link. Please, you can join that link. All right. You will get free materials, study materials for all of your regulatory exams. You will get study free material, mind maps, practice questions and MCQs every day you'll be getting it. So make use of it. It is completely free of cost. So I hope you will make use of it. All right. So I'll see you in the next class, guys. Thank you so much.